All right, hello everyone. It is now 1:30 East Coast time, and the indices are in the green. The futures are in the green, with the exception of, well, now the Dow is. The Russell is not yet. So call the mini Dow flat. The NASDAQ is up 17 basis points. The mini S&P is up 11 basis points. The Russell's down 20 basis points. In the cash markets, the Dow's up 10 bips. The NDX is up 30 bips. The composite's up 24 bips. The SPX, which is the S&P, is up 16 bips. And the Russell is down 6 basis points. VIX is now down on both from an index perspective as well as the futures. The 10-year futures are up. The 10-year index is down. It has been all day, right around 46 basis points. The dollar index is down 55 basis points. I think that's off of the lows of the day. Gold is up 25 basis points. Crude is up 2 basis points. I was just reading, I think it was like a CNBC alert that came out or something like that. You know, crude's in a correction. Here's how to play it. So basically, if that's the case and crude's in a correction, then it is down 10% from peak to trough from its most recent high, which, looking at a daily chart, that looks about right. So here's the high, and right now where it is at, oh, hold on, there's a little window that pops up that tells me what the point difference is and the percentage. So that's right there is almost 11%. So 10% would be right here, right at 59.98, so just below 60. The high it hit, whoops, was like 62 and change. No, more higher now. Wow, 66. Now, about 2 weeks ago, I heard Goldman come out with a forecast for oil, for crude. 6-month forecast, I think it was 82.50. Might have been 87.50, but it was above 80. That doesn't mean it still can't go there. It's just it's in a correction right now. So I wanted to mention, when you're trading any of the futures, be cognizant of the economic events that are coming out. So we talked about the CPI numbers tomorrow. So if you're planning on trading the S&P or the Dow or the NASDAQ or the Russell around the CPI numbers, just be careful. I'll give you a good example, crude oil. When the American Petroleum Institute comes out with their inventory numbers at 4:30 Eastern, and the EIA, which is the federal agency, Energy Information Administration, when they come out with their own numbers, the first 15 minutes after that comes out can be really crazy. So, you know, if they're to come out, if they come out this afternoon and they say, sorry, API is Tuesday afternoons, EIA is Wednesday mornings. The EIA is 6:30. No, that's not right. It's 10:30 Eastern Time. It's an hour after the market opens. If they announce a drawdown, so inventories are diminishing, that's bullish for oil prices in general. If they announce a build, so inventories are increasing, that's generally bearish for prices. But I've seen it where, you know, the numbers come out and there's a build. You'd think that would be bearish for prices, and it does initially it takes a hit down, but then it reverses and it starts climbing up. Why is that? No one knows. So I would just watch it the first 15 minutes. If the information that comes out is bearish enough or bullish enough, you'll get the chance to trade on a pullback, whether it's a pullback up or a pullback down. So that's important to have an economic calendar that you refer to. Have it bookmarked, whether it's Bloomberg or any website that has a pretty reliable economic calendar. Your broker might have one. If you have reminders somewhere, like on your phone or wherever, set a recurring reminder, every week at 4:30 Eastern Time on Tuesdays, the API releases the inventory numbers on petroleum products. That will also, those numbers also can affect, natural gas and heating oil, as well as stocks of companies that are involved in the production of those products. Let's take a look at where our futures are to see what's tradable. The Australian dollar and the New Zealand dollar tend to be pretty highly correlated, although the Australian dollar is more levered to commodity prices because they have such an abundance of natural resources, like the Canadian dollar. Canadian dollar is affected by crude prices because they produce a fair amount of oil. The U.S. does too. Also, the Australian dollar versus the yen, that pair is a barometer of risk sentiment. So if the Australian dollar is bullish relative to the yen, you'd expect the stock market, global stock markets, to also be bullish, or if it's vice versa, because of the yen's safe haven status, that would be a risk-off indicator, just in general. I don't know if I'm seeing anything here that's really catching my attention. I mean, this here, this time period, this was a nice bull run in the S&P futures. That was copper. Another thing to keep in mind is that gold, any economic announcement that comes out that's going to affect the strength or weakness of the US dollar is going to affect gold, and they're negatively correlated. Because gold is a dollar-denominated asset, if something causes the price of a dollar to fall in general, just taking fundamentals off the table, in general, it will be bullish for gold prices. So bearish for the dollar is bullish for gold prices, and commodities also in general, but gold and silver in particular. Here it looks like we've got a coil happening. I don't trade the bond futures much. I don't trade the soft commodity futures much. Partially because like corn and wheat have such weird hours. That still leaves soybeans, soybean oil, soybean meal. They all have a different set of fundamentals that I just haven't really even gotten into. Those are going to be heavily reliant upon inflation expectations and crop reports and things like that, and I just don't subscribe to any of that stuff. So. Having a decent day today, helped largely by my successful trades in the S&P futures. So I might as well stick with those because that's what I've been watching all day. Okay, remember we drew trend lines. And I was an advocate of when you draw trend lines, even after they're violated, you go ahead and leave them on a chart because past resistance becomes future support and vice versa. We had these two minor trend lines here. It was basically the S&P was kind of trading between them in this wedge here. It kind of traded sideways. So this one I'll leave up. I'll leave all these up for at least today. So we have a trade. Earlier, remember I was talking about what is the S&P futures trying to do? What is it doing? What is it trying to do, and how good a job is it trying to get there? Now, we had said before that the futures were trying to trade to the point of control here, which is this light gray line. Well, they did that. They broke through. Now they're trading up to the top of this value area. And remember, value area is where 80% or 70%, depending on how you set your parameters, of the volume traded the day before. So there are studies on your chart. It might be time profile. That tells you where that security spent most of its time. So that your point of control would be where it spent most of the time. Or volume. Where was the most volume traded? At whatever price point the most volume was traded, that becomes your price point. And then you also take a look at what is the structure around that. You like to see a bell curve. If it doesn't form a bell curve, and it's going to be a sideways bell curve, if it doesn't form that bell curve, then look for it to fill in those areas over time. I'm not really going to get into time and volume profile here because I don't use it a lot. I use it to draw the value area and the point of control. I don't use it much beyond that. And also, just so everyone knows, one thing that I will be doing is adding some educational videos. I have a playlist created, but nothing in the playlists yet. I'll either be taking snippets out of my live trading videos, or I'll be recording specific topics. If there's a topic that you want to know about, you know, if somebody requests they want to know how to trade around profile, I'll show you. If you want to know how to use moving averages, if you want to just know the basics like charting, charting patterns and things like that, leave a comment and I'll take all of that, because this channel's for you. So this isn't for me, it's for you. So where we are from the standpoint of the stochastics, basically bearish. Before the 15-minute, or no, this is the 4-minute, my apologies. before this 4-minute, like before I'm ready to declare that we're bearish here, I need to see that full D cross into overbought above 7 or above 80 rather on the stochastic plot. And see how this worked? I don't know if you remember or if you were even watching, but earlier I talked about here where the full D, the slower plot, traded up and but didn't touch. It didn't actually cross into overbought. And what I said was, before the full D trades down into oversold, it's going to try to come back here. It likes to fill that in. Kind of like nature abhors a vacuum. Once full D crosses above 80, the next stop eventually is going to be below 20. And vice versa, once full D crosses below 20, its next stop eventually is going to be above 80. And that's probably true of both measures. I think it's most relevant when you're talking about the slower of the two stochastics, because the full K has the tendency to just make those moves. Because it's faster, it does so more frequently. You're waiting a lot longer for the slower stochastic to make its move. Oh, okay. So right now, S&P futures catching a bid. So I think S&P futures are setting up for a short here. Our fast stochastic is already overbought. Our slow stochastic in the 15-minute is moving in. Likewise with the 1 hour. Sorry, this is 4-minute. This is the 15-minute. So look at this move. This trades, candle opens here, trades all the way up here. Next minute trades all the way down. Once we get the appropriate bearish signal, which on the 4-minute chart we're now starting to see a bearish stochastic histogram bar form. You just missed it. It was red pointing down. Once we get confirmation of that, traveling down through moving averages, because they're so spread apart, I think will be easier. The point of control here is going to be the sticking point. If momentum is sufficient, it will trade through it. I'm not sure that it would be. About a minute, and this next 4-minute bar will form. I'm not going to get on this one. And that's not at all unusual for, I see it all the time. The bar closes, you don't get your confirmation that you're looking for. But on the next bar you do, but you still have 4 minutes to wait or whatever the time period is. In the meantime, it trades down, like you could have taken the short. Now here it's moving up, so that's obviously not what's going on in this case. But have patience, my friend, because this is setting up for a bounce. Right? Once you get the bounce that you're looking for, that's when you make your short. Now, if you don't mind, if you don't mind a drawdown, you can go ahead and get in now. But I can tell you it's going to rip against you, and you're going to have to tolerate looking at red numbers for a little bit until that turn happens. And it might be beyond your pain point. You might panic out and then close the position, and then as soon as you do, it's going to rip in your favor, or what would have been in your favor. And you took a $200 loss or whatever it may be, and you didn't need to. That's why I like to try to get the best trade location I can. I'm not saying right at the top. In an ideal world, I would have sold short right there. If you were to ask me what are the most important traits for a trader to have, it's not brains. I'm not saying it's not important. It's not necessarily knowledge. Okay, it's patience. If you're the kind of person that plays poker and you bet every hand because you have to be in the action, you probably don't make a lot of money at poker. Well, guess what? You're not going to make a lot of money trading either, because you're going to get yourself into some setups that really are not high odds for you. Trading is not about predictions. It's about understanding probabilities and playing those probabilities accordingly. And you don't necessarily have to be a math genius or have taken statistics to do it. Beyond that, I would say discipline. If you have a system, you have to stick to it. Impatience will trump discipline. Starting to see a weakening signal here. This is a 3-period MA. It's turning and crossing below this 9-period. By MA, I mean moving average. It's a price average. It's making a play again for value area high. So also notice Bollinger Bands are widening. The S&Ps from about 10 o'clock this morning, we're trading between either side of the Bollinger Bands. Remember, that is a moving average here. It's a 20-period MA. Usually I have 27 and then 2 standard deviations on either side of that. Generally speaking, when the bands come together, that's a sign of low volatility. It's going to trade in those bands. Once it starts to push one way or the other and pushes those bands out, that's a tradable opportunity. That tells you volatility has come in. There's momentum. That doesn't, you know, still being able to, knowing the direction is important. I've seen it trade push those Bollinger Bands up, and then it just craters, and ultimately where it was going was the downside. It's making a nice run up. That is not a run I want to participate in yet. Starting to see this. Now if I want to make a short play, I can. It's ultimately, I think, going to bounce up against me because this still hasn't completed its move. It's possible that the full K will come down and just push it back down again, in which case that bearish move would be a continuation signal. Here's the other part of it. I've got resistance here. I want to see it break through here before I make a short play. So here's an interesting headline. Jerome Powell suggests the Fed will go ahead with rate hikes despite the market turmoil. So what he's saying is we don't take our cues from the market, we take our cues from the economy. We're not going to hold back on rate hikes because the market has a temper tantrum. Now, I would think a statement like that would be bearish for markets. I don't know when that came out. Timestamp on the story, which is on Bloomberg, by the way. (10:37 a.m.). So that was a while ago. If that's 10:37 Eastern time, it would have been about here. Apparently 2678 is a key level in the S&P 500 from reading my trade flash. Yep.
It stalled as I was trying to make the green light. Like
Okay.
the light turned green, and I took my foot off the brake, and I was like, "Oh crap, it stalled." So the guy behind me is probably thinking, "Okay, he's gonna go," and then I abruptly stopped and put it in park and turned it on. He didn't honk me,
Oh, that's good.
but I was just like, "Really?"
Yeah.
It wasn't stalled while I was at the light. I did the little jerk check, and then
Mhm.
as it turned green, it stalled, and I was like,
Okay.
"That was annoying." And it stalled once, but it was at school. It stalled like this one stalled
Right.
once at school. I hate driving with Kayla and Debbie. It's really annoying. I tried to have a conversation with them. They just ignored me. But they literally just ignore me. I'm actually gonna start paying.
So this is just like kind of waiting for paint to dry. Waiting for so that looks like the move I've been waiting for. So the fact that it closed below that trend line, that's good. That gives me a little bit more confidence in the trade. I would not expect it to trade through the POC, the point of control. It's got the point of control and this 27 period moving average here. Those are both going to be resistance, or support rather. that started off looking okay, but then started seeing this and this. So these are not in line. That was too soon. And really that was just, by moving the stops down, I was able to cut it down to about 2 ticks of risk. Once I could see that momentum was starting to slow down. Might be trying to take a stab at it again. Starting to see this move down with a little bit more conviction, a little bit more momentum. However, I did that because, again, and it literally just changed, but this was turned up, this was turned up. Just telling me that there's going to be a better short in the future. I want to show you, we got competing forces here. We've got a slow stochastic which is trying to move its way down to oversold, which helps us if we want to short. On the other hand, we've got this fast stochastic which is creating upward momentum. Now, this bar is still forming, so it's hard to tell whether this is going to wind up being a bar more bullish or less bullish at 1 o'clock when it completes. Here we have this upside momentum. We have it here as well in the 1 minute chart. This bar will complete in about 15 seconds. Which it just did. So that was confirmation. Now it's stuck right here at the trend line and the moving average. It stopped dead in its tracks. This 4-hour chart tells us that there is some momentum trying to push this up. And the way that this acted just in the last minute kind of tells me that this may not be a short play after all. You want to talk about a couple other characteristics that are important for traders to have? Adaptability and humility. Like, I am faced with the prospect I may have to admit that I was wrong. Like, I thought this was a short play from what I was reading, but now the story that's being told is changing. That narrative is changing. I have to adapt. I have to be adaptable to that, and I have to be willing to admit, like, and it's not even necessarily an admission of guilt, like, well, I read that wrong. No, I mean, I was reading it based on based on the information the market was presenting me. Now it's presenting me with something completely different. Right now it's trying to go to value area high. And not doing a very good job of it either. In fact, right now it's doing a pretty lousy job of it. This is a challenging read to say the least. this line that I just drew, that's a level of resistance from yesterday afternoon. That was when the market started to, when the S&P started to deteriorate just prior to the close. So this is a key level to defend for the bears. If they fail, not good for shorts. You can see a short squeeze. Which is basically shorts covering in a panic because they realize they don't have that. Realizing that this level has been breached. If they successfully defend it, then it's going to push it back into value area down to point of control. And if the bulls fail to defend this area, then it could be all the way down to the bottom of value area. So the problem is you can't short here because you've got this resistance, support rather, which honestly hasn't held up very well. You've got all this congestion here. Moving averages, first of all, the Bollinger Band. You've got your 3-period MA, you got your 9-period MA, you got another 9-period MA because one of them is a simple, the other one's a Wilder's, which is a slower way of calculating it. You've got this 27, 81, 243. Now here's what happens when you don't wait for confirmation. All right. I was waiting for this bar. This was looking like it was going to cross over. I was waiting for this bar to complete and show a bullish signal. Well, it didn't. It moved into the next bar. Well, then what happened? It just ripped down. That would have been painful. So don't not wait for confirmation because you're afraid of missing the move. You might miss some of it, but you might also protect yourself against something like that, where it was a head fake. No, the market's never done that. The market's very truthful and honest. It always tells you exactly where it's going. Well, if that was the case, everybody would do it, and everybody would be making tons of money, and it wouldn't, there wouldn't be a lot of money to be made. Are other futures this choppy? Because this is... It's very difficult to get a good read. Right now, gold and copper are looking pretty bullish. Copper's up 2.5%. That's impressive. And if you look what gold's about to do, well, maybe not. Or let's just take all afternoon. You got a key level of resistance right there. You also have a close above this trend line. So you got gold right now actually looking pretty bullish. You know, from the standpoint of time frames here lining up, right? So as long as we get a break above this level, I think you're good to go from 1331.90 to 1333.50. It's about 15 ticks, 16 ticks. So at $10 a contract, that's 160 in gains. This is a long play to the upside on a pullback. Yeah, this afternoon's been a real challenge. With S&P futures holding the cards real close to the vest. Slower moving averages pulling away faster moving averages pulling away from slower moving averages. That's a positive sign. Trading above this level will be a positive sign. 26.64 if it can break that. Which is trading. There we go. Now we got to be prepared for a potential retreat once it hits value area high. Okay. $26.64 was resistance. It became support. I set my stop at 26.6375, which is one tick below that. The fact that it fell below that, I mean, it got me out, so that was good. But I felt like if it didn't hold at 26.64, it wasn't going to hold at 26.6375. And you can see, I mean, how choppy this is right here. This is low confidence, low conviction for right now. Now the good news is that, I mean, Apple's doing well, Autodesk is doing well. You know, Facebook is not, which is good for me because that's a bearish put spread. I wouldn't mind closing the day at around that level of profit for the day. Yeah, and now we can see things are deteriorating rapidly. So here's what it boils down to, I think, at this point in time. If we trade to one of these levels, if we trade down to 26.57.50, bears have to defend. If they fail, we trade all the way down, probably point of control, all the way down to here, to about 26.45. If the bulls fail to defend here, we trade all the way down to 26.45. If the bears fail to defend here at 26.70.50, then we trade all the way up to 26.78. And this is the midpoint. That yellow line is the midpoint between the bears' line of defense and the bulls' line of defense. Which also happens to be very close to value area high. And look what gold wound up doing. It could not close above that level. So today is a low volatility day. Lower by relative standards. Now, speaking of volatility, one thing I read is that the VIX options, so options on the VIX index, actually expire tomorrow. So most options, like your standard series options, expire on the third Friday of the month. So options on like your SPY or options on your stock indices like SPX or NDX, those expire third Friday of the month. The VIX are different. They expire on the third Wednesday of the month, so they actually expire tomorrow. So there's going to be a lot of volatility. There's been a lot of bets, short bets and long bets on volatility. So as traders settle positions or close up positions in advance of expiration, you can expect there to be a lot of the VIX index itself to move quite a bit, and equities as a corollary of that. So can the S&P close above this midpoint? Can it close above value area? Right now it's making a run for it. Bar closes in 33 seconds. Could not. Could close above midpoint, but could not close above value area. So that's a short, but not a very strong short. And we've got about 31 minutes left in the regular trading hours session. So this is just push, pull, push, pull, push, pull. It's like watching a tug-of-war match between two teams that are pretty evenly matched. Now what the bears have done a good job of is keeping price below the midpoint. Like from a time perspective. So based on that, you might be inclined to give the bears the edge. I mean, 15 minutes to the hour when volatility really, when activity really takes off. Path of least resistance could likely be down. It was yesterday. Okay. This is kind of your no man's land. It's just, you don't want to be stuck there. And if we look at volume, right, this was the open right around here. It's just been higher volume early in the day and just really kind of dwindling volume later in the day. Bulls are making another play. Now in about 10 seconds, this bar will close. And it will have closed not only above the midpoint, but, well, it failed to close. See what I mean? Like with 2 seconds to go, it looks like it's going to happen, and then boom, it just gets pushed right back down. So that behavior can drive you nuts when you're waiting for confirmation. So NASDAQ issues are ripping. Apple's ripping up. Autodesk is ripping up. Okay. Bulls are starting to build some strength here. And we're starting to lose it. So they were able to close above value area, we were able to close above midpoint. Didn't matter. As the bears are smacking them down again. And we got about 3.5 minutes before the 15-minute bar closes. So in other words, we got 15 minutes left in the session, which tends to be the most volatile time of day besides the opening. And right now this is moving pretty decisively in the bears' favor. So the fact that the bulls failed to defend, I mean, they didn't fail to defend this area, but they were showing some strength and then they just kind of petered out. And same thing on a NASDAQ chart. Even though the 4-minute bar closed above this line of resistance here, it didn't shoot up very high and then it just kind of traded right back down below. So now we're getting a real vicious rip to the downside. See, and look what happened. Volume traded above that trend line. What color is that bar? It's red. So even if we adjust it up a little bit, I just took out half my profits. This bar closes at 1352. See, and here's the real problem. When you're too stochastic, when you're fast and you're slow are so close together, this is the only exception, right? It's just volatility. It's just chop and slop like what we're seeing. We just got to close above. Didn't matter. That close above did not matter. So this is a volatile, fickle, low conviction, directionless what this tells me is that a lot is hinging on the CPI number tomorrow morning. Because no one wants to get caught flat-footed when that number comes out. If the number comes out lower than consensus, then there's going to be a short squeeze. It's going to rip to the upside. If that number comes out in below consensus, that will be bullish for the stock market, and the shorts will get shaken out. Remember, that's at 8:30 Eastern time, folks. So I would not want to be in a trade when that number comes out. I would want to be prepared to trade it. This is ridiculous. Absolutely ridiculous. Trading that was ill-advised. That basically got my so basically I made zero profit on the S&P futures today. The first trade that didn't go to my liking should have been the indication, don't do this. It really should have been. Because you work too hard to watch it evaporate that easily. And with 46 seconds to go, and that's it. It's 2 o'clock. So this market basically spent an hour and a half. No, 2.5 hours trading in a 10-point range. This market spent 2.5 hours trading in a 10-point range. So let's recap and talk about tomorrow. Dow ends up 40 points. NDX up 30 points. Composite up 31 points. SPX up 7 points. The RUT up 4 points. So that's anywhere between 16 basis points and 46. The index was the best performer. The 10-year Treasury Index down 60 bips. The VIX was down 1.3%. VIX futures were down about the same, 1.45%. And kind of a similar story on the futures. Up anywhere between, you know, 0.1% and 0.4%. Gold up 40 basis points. Dollar index down 60 basis points. So if we talk about tomorrow, this is going to look funky. I'll explain it in a second. This is the time profile. This yellow area represents last week where the S&P futures spent most of their time. This orange bar here represents where the S&P futures, the price level at which the most volume changed hands. This level here was the high point. This level was the low point, so this was the range. Okay. 50% of the range, the midpoint of the range was right here. So what you might expect the following week if we do a Fibonacci expansion, or extension rather, would be a trade down. Now we're not going to use Fibonacci levels, we're going to use overbought and oversold levels. Now this level here represents the midpoint of yesterday's range. Now notice that the last 2 days of trading has been around that midpoint. If the CPI number comes in better than expected, in other words, well, let me rephrase that. If the CPI number comes in lower than consensus, that's going to be bullish for the stock market. And I would expect the S&P futures to trade up to about here. First stop, 27.33. Next stop, 27.85. Anything above 27.85 would be considered kind of oversold. It's your 80-20, your thresholds, right? On the other hand, if the CPI number comes in hotter than consensus, that would be bearish for the market, and it will, I would expect it would trade down to 25.59 first stop, next stop 25.07. So mark those spots if you're watching. First upside target 27.33, second upside target 27.85, first downside target 25.59, second downside target 25.07. So that's all I got. I hope everyone I enjoyed it before I gave all my profits back, but you know, tomorrow's another day. So we'll see you here tomorrow. Thanks, everybody.